About 2 years ago, the Angel Capital Association started a data collection project to figure out exactly who we are, what we do, and where the money is going. So I'm going to share with you today the results of our most recent study that was unveiled last week at our annual summit. So we did a representative sample of about nearly 70 companies out of our 70 angel groups out of our 300. And the number of deals the study represents is about nearly 1,200. These are investments in the 900 companies, and for this sample, about $1.8 billion worth of deals. The total amount raised per deal, as you can see, is typically for angels in the participating in rounds is in $1 to $3 million. Obviously, this is money that's syndicated. Almost none of our money went into very, very, very large rounds, as you would expect. So investments by round, we did almost no work in the pre-seed category, and the Series A, B, and C, that's mostly follow-on investments. So over half the money went into seed stage, with the rest being follow-on. As you can see, we're getting very clearly defined investment classes now, where seed stage has its own thing, and it's dominated by angels, whereas pre-seed is very much the stuff of incubators, accelerators, friends, and family. The top industry sectors include IT, healthcare, and consumer products. And so those are the big bulges, but the rest of our money, which went into areas like food, for example, these are more broadly distributed, saying that the angels today are investing very broadly in a much wider sphere of things than simply IT and health. In terms of where the big sub-segments are going, roughly something on the order of 25% of our money went into in health and biotech, and the rest, again, is fairly widely distributed, with 4 or 5% of our money going into many, many different sectors. So again, angels today are much more diversified than they were 10 years ago, but almost all the money went into healthcare or IT. We're also much, much more diversified in where the money goes. Now, you all know that VCs spend about 30 to 40% of all the U.S. venture capital right here in Silicon Valley. Angels are much smarter than that. They're looking for deals all over the United States, and you can see the diversity of where we are investing. Almost every segment of the U.S. and at least 3 major provinces in Canada are getting substantial angel dollars. If you look next at valuations, whether this is caps on notes or whether this is free money, you can see that by and large, most of our deals are under $8 million in valuation. This contrasts sharply with 2018's venture capital statistics from the NVCA, which says that the typical valuation for Series A VC deals was $25 million. So just think 2/3 is under $8 million. And when you're thinking about your own valuations, get that kind of into perspective. The valuation breakdowns by round, as you can see in the seed stage, only 16% were above $8 million, whereas for VCs, over half the Series A deals and the vast majority of Series B and Series C were way in excess of $8 million. So again, when you're scaling your own capital needs, think of the investors you're approaching when you're thinking about valuation. Pre-money caps by region, there is a message here. In the areas where there are lots of investors, deals are much more competitive, pushing up valuations. For you investors, you want a great deal, go to the Great Plains, go to Northwest, go to Texas, go to the Great Lakes, and you're going to find less competitive deal environments and potentially way better valuations than the lunacy you find in New England or California. Valuations for the top 15 verticals, The more capital intensive the deal is, which includes enterprise software, which usually takes big rounds because it's so capital inefficient in its sales models. By and large, the valuations are around $14 million to $11 million in those sectors, except a few that are extremely capital intensive. In terms of seed round valuations, the top verticals would be brain research, neurotech, logistics, and insurance. All of those are brand new investing sectors. They're hot and they're getting higher valuations. Most other sectors are in the $7, $8 million range, as they've been for the last year or so. In terms of investment structures, how many of you are excited by SAFEs? How many of you are looking at SAFEs as a primary investment vehicle? Anyone in the room? Okay, well that's encouraging. Because about half of all angel investments go into straight price rounds, traditional price rounds. And about 45% are going into convertible notes. 1.6% of angel deals nationwide went into SAFEs. Why? Because there is no reason for an angel to do a SAFE. There's very little investment protection. There's very little upside in a SAFE note compared to a standard price equity round. So as you're thinking about deal structures for angels, approaching angel groups, think about priced equity or about convertible notes. Priced equity rounds, in certain cases, are getting roughly twice the investment as convertible notes. One of the big trends in the angel investing over the past 4 or 5 years has been syndication. 2/3 of angel deals are syndicated, first with other angel groups, and second with VCs and angels working together. So it's not unusual for an angel round to be in the range of $1.5 to $3 million, because it's not just us putting our money to work, it's our syndication partner as well. As I mentioned before, this is the distribution of angel groups, and we're seeing lots of angel capital across the U.S. and in, as I said, 3 provinces of Canada. About almost half the money going into companies or companies with 5 employees or less. But that does not mean 1 employee. Almost no deals had one employee. On average, you get 2 to 3 times the amount of money the more mature your company is. So companies under 10 employees got a lot less money than companies with employees in the 11 to 20 employee range. Angels, like most people, want de-risk deals, more employees, lower risk. Therefore, the amount of capital is roughly triple that for very early stage angel investments. Revenues at time of funding, only about a quarter of angel deals were for companies with no revenues. So again, if you're approaching angels, think about revenues. In terms of diversity, we have gone from almost no women CEOs being funded now to about 20-23%. This contrasts with venture capitalists who are funding women around 2 to 3% of deals. Experienced CEOs are getting substantially more money than inexperienced CEOs if they are male. We have work to do in that regard. And in terms of the total number of deals per group, it's around on average 16. The total dollars invested per group is roughly between $100,000 and $250,000 on average. But again, we syndicate, so deal sizes can be larger. The number of members in a deal, typically 5 to 10. The last point is we are less control-oriented than venture capitalists are. They want to take your soul. We really want to influence your outcome. So about 1/3 of angel deals requires a board seat. Last point is, on average, a well-formed angel portfolio typically yields 2.6x as a multiple, 2.6x the amount invested. And that data is about 5 years old. We're now working on a next generation of this report to look at angel returns. So stay tuned, because because the bottom line for us is best practices will hopefully yield great returns. We want to unlock the magic. So if you are an angel investor, encourage your group to submit data to our data collection effort. Anybody wants to learn more about the Angel Capital Association and what we do in education, data, training, and government lobbying, please let me know. Thanks very much.